Mike Douglas is Michigan's retirement coach.
Glad to have you here with us alongside Michigan's retirement coach, certified financial planner, Mike Douglas, who is here to share his ideas, his insight, his education with you. So many of us are lacking the financial education that we need, considering how much it is put upon us now to figure out our retirement plan. For parents and grandparents, retirement used to be 10 years. Now we're looking at 20, 30, and 40 years for some folks. You're going to be in retirement as long as you were in the working world. Is your money ready? This is what Mike is here to help you figure out. So find us at michigansretirementcoach.com. You can also click on the links we've got posted in the show notes. And don't forget to subscribe to our YouTube channel. Just search Michigan's Retirement Coach on YouTube. You can subscribe to our channel and watch that way as well. I want to ask you about something specific today. Thinking about all the things we don't know. The misunderstanding, because for a lot of people, they have ideas on things. They have awareness of things. They just don't realize what their options are when it comes to RMDs. This is what we're going to specifically focus on today.
Yep.
Because there was an article on Morningstar.com saying that retirees often misunderstand RMDs, required minimum distributions. When the government makes you take withdrawals from your traditional, aka pre-tax accounts, your think 401k, your traditional IRA, and the government does so they can get its cut because you haven't been taxed on it yet. They want that money. So required minimum distributions, where are we at with age timeframes on that?
So right now, as it stands, at age 73, now this is not on inherited money. This is just your money.
Okay.
At age 73, you have to start taking out some money every year.
Okay.
That is going to age 75 in 2034.
So between 73 and 75. So for those folks that are now being forced to withdraw this money from their pre-tax accounts, a lot of them think that it's money that they are then therefore forced to spend. But is there a reality check that we need to talk about in that space? Should you reinvest any of the RMD money? I guess the idea, the concept we want to think about here is you don't have to spend that money, but what should you do with it then?
Yeah. And so there's a couple things. There's what you can do and what you should do. Okay. So I think there's some misconceptions about it. And so what we want to do is just give people the information to make the right choice for them. So by no means is this a recommendation, but here are the options that are out there too.
Okay.
What the government cares about is that there's these two worlds of money. It's called qualified and non-qualified money. Qualified money is money with some type of tax incentive from the government, one way or the other.
Yeah.
So if you have a 401k or a rollover IRA, it's money that you put in and you didn't pay taxes on. Your employer may have put money in and they didn't pay taxes on, and then the market grew it and you've never paid taxes on it. Right? So that's tax deferred. That's a qualified account.
It is the way I understand it, the way I explained to myself, that it's qualified because it is qualified to be taxed.
Sometimes, yes. That's why I say qualified just means there's a tax treatment.
Okay.
Because Roth IRAs are also qualified accounts.
Oh, okay.
But those are money you've already paid taxes on, and as a result, it never will be taxed again. The gains will never be taxed. So that's a qualified account, but it's a Roth IRA, individual retirement account. So the qualified money is over here. A required minimum distribution says that money from your pre-tax accounts has to leave qualified accounts and go over to non-qualified.
Okay.
Well, what's non-qualified?
Yeah.
Like a joint account that you have that's a brokerage, a trust account, something like that, where there's no tax advantages.
Okay.
If you have a joint account or a brokerage account on your own and you invest in it and you trade it through the year, buy and sell stocks, well, then you pay taxes every year on the gains or losses, and it works itself out. There is no deferral and there is no tax-free. It's all taxable. So that's the two worlds. So when it comes to required minimum distributions, as it stands now with the law, there is no required distributions on your Roth IRA, but there is on your other accounts starting at 73. When that money comes out, it has to go to non-qualified over here.
Okay.
When you do that, they take taxes out, and then what's left goes to you. You can spend it. You can reinvest it into your non-qualified account and go buy stock. So if you have Apple stock in your IRA and you want to keep it in Apple stock, okay, well, then you have to put it over into a non-qualified, pay tax on it, and you can own the Apple stock here.
Okay.
You can use it for trips, for vacations, gifting, all these different things, but you have to settle up on taxes. If you have inherited accounts, there's some other rules, but right now, as it stands, if you inherit an IRA over the course of 10 years, you have to take that money out and distribute it to non-qualified accounts. And there's a certain amount you have to take out every year as well. So that's how required minimum distributions work.
Okay.
And so if that's how they work, are there any strategies we can use to make it maybe beneficial or more timely for when we take it out?
Right.
There are certain things we can do. So now that we understand that there's qualified money and non-qualified money, and that they make you take out from pre-tax, and people say, well, can I Roth convert my RMD? You cannot, because remember, it has to leave this world and go over here.
Okay.
And your Roth IRA is over here. So you cannot Roth convert your RMD. If you want to do charitable giving, if you want to be philanthropic, if you have something you're passionate about, typically what would happen is when we give to a charity, you earn money, you pay taxes on that money, it goes into your bank account with what's left. Out of what's left, you give to a church or charity, right? And so they've taken taxes here. Out of what's left, you give to church or charity. And then from there, that money is deductible and you don't pay income on it. But remember, they already took a cut out of your income to start. So if you have required distribution, let's say this year you have to take out $10,000 for your required distribution. If you take it, put it into your non-qualified, and then you give it to charity, out of the $10,000, the government takes their $2,500, $3,000 in taxes. And then out of the $7,000 that's left, you give it to charity, and they deduct the charity that $7,000 from your income. The charity gets $7,000, and you and the government get to settle up on taxes. If you do what's called a qualified charitable distribution, QCD, that money, that full $10,000 goes directly to the charity. They get all $10,000. It satisfies your RMD and you never pay taxes on it.
Okay.
So if you're passionate about the project, about the charity, about the church, they get more money and you get the same net result.
Okay.
Those have to be done using specific forms.
Right.
It's not difficult, but it's very doable. But you just got to make sure you fill the forms out the right way. And
otherwise, you can create a worse tax situation, right? If it's done wrong.
Well, not even necessarily a worse tax situation. It's just the charity gets more money.
Yeah.
If you do the same thing, you take the 7,000 shows up, the government takes their 3. Then you give 7 to the charity. The government's going to, you're going to settle up on the 3,000 because you donated $7,000.
Yeah.
The charity gets less money.
Yeah.
So you might as well give the charity the 3.
Yeah.
And it all gets satisfied and you're good to go.
Okay.
So it's a way of just making sure that your passions or your causes get more money and you and the government still stay square.
Yeah.
So qualified charitable distributions, the charity gets more. Another question is, well, can I Roth convert it? And we said you can't Roth convert your RMD.
Right.
However, you can use the RMD and Roth conversion. At the office, we call this a backdoor RMD conversion.
Okay.
A lot of people have heard about a backdoor Roth where I earn too much money, so I put in an IRA, then I convert it. If you say, I want to convert money to Roth, but I have to take an RMD out, and I know my RMD can't be converted. So let's take that same number. 10,000 is what you have to take out. You're not doing QCDs. So 3,000 goes to taxes and 7,000 ends up in your bank account. And now you want to do some Roth conversion. Now that your RMD has been satisfied, you can convert. So what we do with clients is we take that $7,000 and we back it out and figure out how much we can Roth convert and use the $7,000 to pay the taxes. We just did this with a client the other day, and the numbers were pretty close to this. Actually, they had like a $7,500 net after their RMD was done. And so we backed it out using their tax brackets, using tax software that we have. And we figured out they could convert $35,000 in whole, just a straight $35,000 straight over.
Yeah.
The $7,500 that they had from RMD after taxes covered the taxes on it.
Oh.
So as a result, they didn't want the RMD.
Yeah.
And they wanted to do Roth conversion. I said, well, you have to take the RMD, pay the taxes, then use that RMD to cover the taxes on a Roth conversion. So it was a great way to help them understand that even though I can't convert it, I can use it as part of the process.
Right.
And then when we converted the $35,000 from IRA to Roth, we did zero withholding because we took that RMD and used the whole thing.
Okay.
Typically in a Roth conversion, if I take money, 35,000 over there, we withhold it and only 28 grand shows up in the Roth. This way, the whole 35. So it's a little bit of an engineered way.
Okay.
But in that process is why you need someone who kind of nerds out on this stuff to walk it through. But there are ways to use it. It's something that people say, well, I don't really want this RMD. Great. Well, then use it for Roth conversion, use it for charity, or gift it. Give the money away. Stay under the gift taxing rules. But there's a lot of things you can do. You do not have to reinvest it, and you do not have to spend it. So don't feel like it's one way or the other.
Okay.
A lot of times we encourage people to spend it because you live once. And I say, even if you spend it on your kids, grandkids, something else, let's find ways to make this money go farther than just switching from account to account.
Yeah.
But there are definitely some options. Qualified charitable distributions, use the backdoor RMD conversion plan, gift. Just there's quite a few things you can do.
Mm-hmm. Thinking about, I guess because so many people just feel forced backed into a corner with RMDs. That's just one thing when it comes to so many things that we feel out of control with for our retirement plan, not just RMDs, because going to that tax conversation, the lack, and the first thing I was saying, didn't I just start the conversation saying the lack of education we have is startling, and the lack of things that we have awareness of? There is no point in feeling trapped because there are so many options. But that's, I think, also where it gets hard for people because you open the door to figuring this stuff out and there's a flood of information that comes at you. You just like shove that door. Like the episode in Friends where Chandler opens up Monica's junk closet and like all the stuff comes falling out. It's like, shove it back in there. I don't feel like dealing with this right now.
You weren't supposed to see that. Well, it's funny too, because we hate being told what to do with our own money. Mm-hmm. We all hate that, right? Nobody likes to be told what they have to do. The second is we don't like feeling powerless.
Yeah.
And we're also scared because there are rules to RMDs. If you don't satisfy your RMD, there's a 50% penalty.
You get slapped on the hand and face in some cases.
If you have a sizable RMD, there are people who have 50 to 100,000 RMDs. And if you miss it, it's 50% of the RMD is the fee you pay. It's the fine. That's
on top of having to pay on top of.
Yeah. Now we have helped some people in the past who they may have missed it. And we were able to use a certain IRS form and letter of explanation to get it remedied and fixed so there was no fee.
Okay.
You can't count on it. It's not a guarantee to work.
Yeah.
But we've used it in the past and it's been successful.
Yeah.
But when you do that, you just have to work with someone who knows that landscape because it is a little bit complicated. But we're threatened with fees and penalties. We're told we have to do it and we're told just take the money. Well, again, like we talked about, there's other options. It's your money. Accomplish your lifetime goals with it. If your goal is to leave a legacy or to be philanthropic or charitable, or just to build up the giant pot of gold, that way the day you die, your grandkids get to Scrooge McDuck dive their way through it, whatever it is, right? Like whatever you want it to look like, there is control you can take over your required distributions. You just have to know the rules, play within the rules so you can win within the rules.
If you are wondering about the rules, though, and where to even begin to start figuring all of these things out, Mike and his team, they are here to help, offer up some education, offer up some individualized, customized planning to you because it's different for everybody. And what you can do with your RMDs and all the other things that are factored into your savings are unique to you. So got to get to work on your individual plan. MichigansRetirementCoach.com is where to go to start the conversation with Mike and his team. We also have links posted in the show notes. Let's get to work helping you fully understand your opportunities, educating you on what RMDs are, how to take advantage of some opportunities they might, in fact, present to you. Again, it's MichigansRetirementCoach.com.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.